Good morning, everybody. My name is Simon Hamilton. I'm the Chief Executive of Belfast Chamber. You're all very welcome to this morning's event. This morning's event is the latest in our Belfast Talks business series, which many of you will know is sponsored by Ulster Bank. And I just want to once again thank Ulster Bank for their continued support for this series of online events. We are at the beginning of a new year, and to many of us it feels like we're turning the page on the pandemic, but like a good book, we're not entirely sure what's going to happen next. To hopefully help us maybe building this up, help us to unravel some of those uncertainties and answer some of the questions that we might have. We're very, very pleased to be joined by Richard Ramsey. Richard would be no stranger to many of you. Richard is the Chief Economist at Ulster Bank, Northern Ireland. Richard, you're very, very welcome. Richard is going to share his thoughts on where the economy is, and more importantly, perhaps where he thinks it is heading, and what the challenges that might lie ahead are. I'm sure that many of you will have questions as normal. There is a question and answer function is open to you. If there's anything that you want to put to Richard, please put a question down there, and we will do our very, very best at the end to go through as many as we possibly can. But with no further delay, I'm going to hand over to our main event, which is Richard. Richard, over to you for your presentation. Very much look forward to hearing from it. Thank you.
Okay, thanks very much, Simon, and good morning, everybody. And I suppose you sort of think, if you look back over the last year, what a difference a year makes when we think to where the economy is now to where it was this time last year, and not just in terms of the economy, but clearly with the pandemic, the rollout of the vaccines, etc. In many ways, we're in a much better place today, looking forward, than we were this time last year. So just next slide, please. But I'm almost reminded of when people are talking about, we've recovered lost output, we've got jobs which are back above pre-pandemic levels, unemployment very low, etc. It makes me think of George Bush and his mission accomplished speech back in 1st of May 2003. He didn't actually utter those words, but he implied that the war in Iraq was over, or moving to a new stage where the Allies had prevailed, and he was implying that it was over, and it was very much dubbed the mission accomplished speech. But actually, in terms of collateral damage, in terms of civilian and military deaths and injuries, there was more collateral damage that occurred after that speech than occurred before that. And in many ways, I think that chimes with the economy. When we think we're over the worst of it, in many ways, what most households will find is that the coming year is going to be more painful than what happened at the peak of the pandemic back in 2020. Next slide, please. So if we just look at a couple of charts in terms of where we have seen mission accomplished as far as economic output's concerned. The chart on the left-hand side is the Northern Ireland Economic Composite Index, which is the nearest thing that we have to GDP. And you can see the pre-pandemic level, which was Q4 2019. The blue line is the Composite Economic Index, including public sector, and the orange line is the private sector. And what you can see is, yes, we had a record rate of decline. During the first lockdown, there was a recovery. It wasn't quite a V-shaped recovery, but we have seen then since the second and third quarter of last year, we've seen strong growth. And actually, since the second quarter of last year, we actually returned to pre-pandemic levels. So the composite index is now at a 13-year high. And in many ways, you would think that's what people thought at the time of the pandemic is, how long is it going to take to get back to pre-pandemic levels? It's taken much shorter than economists such as myself initially thought. But getting back to those levels, while it is encouraging that we've got back so quickly, it isn't an end in itself, and there's still, the war isn't over in terms of the economic challenges going ahead. If we look in the right-hand chart, that is just looking at the number of employees on Northern Ireland payrolls and the numbers in thousands relative to the pre-pandemic level of February 2020, where there was 753,000. We saw a big hit, and we've now seen a recovery. And in fact, there's now 20,000 more people on payrolls at December than there were during the pandemic. So in the face of that, that looks really impressive. But if we move to the next slide, we can see other indicators that have exceeded expectations, particularly unemployment rate, where Northern Ireland is the orange line. And it's actually, it was kind of this time last year, people, including myself, were thinking that the unemployment rate after the full period would expire would go above 10%. And that was what the Bank of England thought for the UK as well at a stage. And but we see that the unemployment rate is actually at 3.1%, one of its lowest levels ever. So the surge in post-furlough unemployment, although this data is only for September to November last year, and it doesn't fully encapsulate the post-furlough period, it is remarkably low, and that is encouraging. Then if you look at property transactions as well, the property market, whenever we heard the pandemic, whenever the pandemic and the lockdowns were hitting in the first quarter, we thought there was going to be house price falls, and we thought there was going to be housing market sales and transactions would plummet, which they did, but they have recovered. And this is just looking at the 12-month average relative to the pre-pandemic level. And at the end of 2021, residential transactions, they were up almost 50% year on year relative to the previous year, but they're 24% higher than they were for 2019. And it's not just that, it's also commercial, the non-residential also has recovered. So it's 8% higher than pre-pandemic levels. So next slide, please. So while in the face of it, everything looks like mission accomplished, it has been an unbalanced recovery. And there was in the latest Chamber of Commerce quarterly economic survey, what they talked about was that a third of firms are performing better than they were before COVID, a third are performing largely the same, and a third are performing worse. So it shows you that there's a variety of impacts and performance. This table here is just looking at the quarterly economic output for various sectors as of Q3 2021, which is the latest figures, relative to pre-pandemic levels, Q4 2019. And you can see sort of up at the top of that, you have some of the COVID-19 winners. You've got the kind of chemical and pharmaceutical products. You think of Almac, Norbrook, Randox, etc., who did particularly well, up 30-odd%. The kind of PPE-related sectors, such as textiles, also 15% higher. You've got rubber and plastics as well, which benefited from COVID, also doing well. But what you're also seeing is now we've got most sectors are now back above pre-COVID levels, which is encouraging, but some of them aren't. And I suppose the one that sticks out the most is transport equipment, which is the aerospace sector, and we know how hard it's been hit. So levels of activity there in the third quarter of last year were 40% below pre-pandemic levels. So clearly mission is not accomplished in terms of recovery for that sector. Next slide, please. And if we also sort of look at the employment, how some of the headline statistics that I presented earlier are almost provide a sort of flatter the view on how the labour market recovery has been. If you look at the chart on the left, this is looking at the number of weekly hours worked. And you can see that the latest figures for the 3 months to November last year were still 6% below where they were for the corresponding 3 months in 2019 before the pandemic. And the reason that that's the case is because total hours worked is not just employees, people on payrolls, it's also the likes of the self-employed. And you can see the chart on the right, how Northern Ireland, of all the UK regions, saw the biggest fall in self-employment. And you can see that huge fall, over 30% decline in self-employment. It has started to recover since the summer. But what you would have seen there has been, when COVID first struck, there was a kind of flight to safety where there was a lot of self-employed, then moved in, their businesses weren't viable, or they moved in to then become employees. So that's why almost we've seen the more marked recovery in terms of payroll numbers, people who actually work for an employer. And what we'd expect to see is you could actually see the employee numbers fall off a bit if people then start going back into self-employment. Next slide, please. So that was all kind of looking back. If we look at where the economy is globally at the minute, we look at the global Purchasing Managers Index, or PMI. That's the chart on the right, or sorry, the chart on the left. And people familiar with the PMIs, what the PMIs show is it's a survey of companies, and anything above the 50, the horizontal line, is growth. The higher the number, the faster the rate of growth. Conversely, anything below that line is decline. The lower the number, the faster the rate of contraction. So what you can see is that there has been a recovery, but with global output, it has slowed to an 18-month low as of January last month. Reason for this is we've got the Omicron sort of spread of the Omicron wave has been hitting other parts of the rest of the world. It's kind of lagged. It's lagged behind the likes of UK, which had it relatively earlier. So you can see the slowdown in growth, and the reason for that is also linked to the supply chain disruption. And one of the indicators which people rarely looked at before the pandemic was supplier delivery times, and the PMI Supplier Delivery Times Index. And what this chart on the right shows is that you're still seeing significant lengthening in supply chains. So you're getting supply chain disruption, you've got, and that is causing problems with output. And even I was reading there about Nike's sports shoes, that they're having supply chain disruption, and that's delaying their launch of some of their premier sort of shoes and products, where they're trying to wait until they can get sufficient stock before they actually do a launch. So that's an issue which has continued to blight the economy. And while it's expected to fade later this year, it hasn't. The supply chain disruption has lasted much longer than people had previously thought. Next slide. If we turn to Northern Ireland in terms of some of the latest figures, and we look at its PMI, and the chart on the left is looking at private sector business activity for Northern Ireland in red, the Republic of Ireland in green, and the UK in blue. And you can see as of December, which is the latest figures, you were seeing there was a slowdown where private sector activity was almost grinding to a halt in Northern Ireland. That was largely due to the services sector, which in turn was linked to the hospitality sector and the impact of the Omicron wave hitting activity. We've got the January figures due out on Monday. And what we would be expecting to see is that you'll see actually a recovery in that, because the Omicron wave has subsided, and you should see all of those economies actually then reporting a rise in activity. We're also seeing on the right-hand side, then looking at employment levels, you can see that both Northern Ireland, the Republic of Ireland, and the UK, very, very strong employment growth, which has continued over the last 10 months or so. Next slide, please. But the key challenges which are facing businesses at the minute continue to be on the inflationary front. And the chart on the left is just looking at input cost inflation for Northern Ireland businesses. Remember, anything above that red horizontal line is rising prices, input costs. So that's your wages, raw material, energy costs, particularly freight costs. And they have recently hit a record high in December. They sort of eased slightly. And with input costs rising at record rates, firms are then having to pass on these prices, these cost increases in terms of increasing the prices of their goods and services. And you can see that chart on the right as well. We recently hit a record high, but it's eased back slightly. But when you think of those cost pressures, that also means a squeeze for a lot of companies. It's a squeeze on their profit margins and profitability. Next slide, please. So whenever I was talking about supply chain disruption and what does it look like, probably one of the best examples of it is looking at how it's affected the new car sales market. And you've probably, anybody trying to get a car will know all about that. I know I ordered up a car at the start of July, which is for delivery next month, but that's still looking unlikely. And you can see the new car sales, they fell to a record low in 2020. And the recovery, even though demand is strong, they only increased by about 1% year on year in 2021. They're still 29% below 2019 levels or pre-pandemic levels. And that's been due to the shortage of semiconductors, the difficulties trying to get parts, and also whenever the car production sort of shut down during the initial phase of the lockdowns when the pandemic hit. One of the impacts of the fall in new car sales is it means that the flow of new car sales which go into the used car market has kind of stalled, and the net result of that is you're probably all aware of that secondhand car prices have gone through the roof. And you can see this is for UK prices. As of December, they're up 29% year on year, and that's a record rise. And clearly that's another issue when we talk about the whole cost of living crisis. That's buying a secondhand car is another cost and another pressure. Ultimately, whenever the new car sales start flowing again, the supply chains of the car dealers, if they start flowing again, you're going to see those secondhand used car prices fall, and there's a bit of a bubble there. Next slide. But one of the biggest issues sort of going on at the minute is then the whole hiring boom and the skills shortages. And indeed, if we look at the Northern Ireland Chamber of Commerce survey for quarterly economic survey for Q4 last year, there were 72% of local firms are trying to recruit. 86% of those firms are currently facing recruitment difficulties. The chart on the left here is looking at the Northern Ireland jobs.com website, its job listings index. And you can see that we had this sort of record fall during the first lockdown, but since then there's been a hiring boom, and job listings on their website have more than doubled relative to Q1 2018. They have eased off slightly in Q4 relative to Q3, as a lot of those vacancies have been filled. But if we look at the right-hand side, and the top 5 listings were nursing, healthcare and medical, hospitality, IT. There was also accountancy and finance, and sales were the top 5, and they accounted for 50% of job listings. But I've highlighted the nursing, healthcare and medical and hospitality sectors, and you can see the phenomenal rate of growth there. And what the hospitality and the nursing and healthcare and medical highlight is the attrition that has been going on in terms of jobs. So while some sectors, such as the pharma sector, has seen huge growth in recruitment, that is linked to new jobs and expansion, whereas a lot of the nursing and hospitality jobs are looked at replacement. And there's been huge turnover during what has been dubbed the Great Resignation, where people have been deciding to opt out of working in either hospitality or nursing. And clearly that's presenting a problem for employers in those particular fields. The way nursing has expanded in terms of the recruitment market, if you think back to 2019, 5% of all jobs were in the nursing, healthcare and medical category, whereas now it's 21%. If you look at hospitality, there's 1 in 10 of all the vacancies on the nijobs.com are in hospitality. And clearly that highlights the whole issue of turnover and attrition and the difficulties getting workers. Next slide, please. Then arguably the biggest issue of the year is the cost of living crisis, and I've dubbed it Cost of Living Crisis 2, the sequel. Remember, there was a cost of living crisis back after the last financial crisis, and there's some similarities and some key differences. One of the key differences was back then, after the financial crisis, unemployment rate hit about 8%, so 3.1% currently. So, and one of the things, people who were relatively passive in terms of going for pay, in terms of pay rises, where they were content to actually have pay freezes in public and private sector with very little pushback in terms of industrial action, because they were just grateful and thankful to have a job. Whereas this time round, you've got massive shortages and you've got massive pressure to increase wages. Just some of the key headings here from the Financial Times the other day about worst squeeze in disposable income for 30 years. Chairman of Tesco's warning of 5% rise in prices this spring, which would take food prices up year on year, if you think March, April, up to 9%, maybe even close to a 10% year on year increases in food prices. And of course, you'll all be aware of then energy prices, gas rises, etc., where the latest price hike from Firmus of up almost a third. But in the bottom left, one of the recent news items the other day was about Northern Ireland could face extreme poverty, and that it was saying the number of households in poverty could increase by 67%, and Northern Ireland would be the most adversely affected of all UK regions. And that would 67% rise, that would then involve 25,000 households. So key problems and pressures there. If we go on to the next slide. And what we've seen over the last year has been the year of last year was the year of rising prices. What people tend to forget, we've got the oil price, Brent crude oil price on the left, and I've priced that in sterling, in pounds, as opposed to in dollars. And you can see that what people sort of forgot, if you look at that low of £16 a barrel back in the first lockdown, was the fact that whenever the pandemic was at its kind of worst at the start in the first lockdown, many households never had it so good. You were having petrol prices were falling, diesel prices falling, utility bills falling. You were having pandemic savings were mounting. And, that was all pretty good. Whereas now you've seen that sort of likes of the oil price, where look how much it's gone from £16 a barrel up to £69 a barrel. So far this year, it's up 20% year to date, and it's up 330% since that low of April in 2020. And you can see petrol and diesel prices also pushing higher, where you've got the likes of petrol is currently up 40 pence per litre from its May to 2020 low, and diesel is up 37 pence per litre. So big pressures on motorists, and also that's in terms of, you think of logistics, haulage firms, and how all those rising costs, which will then have to be passed on to consumers. Next slide, please. So then, it's also just then on the gas price front as well, and the chart on the left shows the price per therm of UK gas prices, and you can just see the scale of, from the left-hand side, how in 2019 pre-pandemic, and how gas prices have absolutely rocketed. So they're up several times relative to what they were pre-pandemic. And if you think and in Northern Ireland, we've had a variety of energy price increases in terms of gas, and linked to that is also electricity price rises already. But if we look forward, the worrying thing is the futures curve is what the financial markets think the future gas price is going to be. And if you look at the purple line, which shows that the gas prices, while they may come down a bit, they're still going to remain very high for the rest of this year, maybe into the first half of next year. And even when they come down a bit further, they're still going to be, you're looking at high prices for 2 to 3 years, and that's higher than what was predicted in November, which you can see that line, the sort of lower line, whenever the Bank of England did its forecast back then. So that's huge pressures. And that gas and energy prices, that hits food producers and will feed on to food price inflation, which I talked about, Tesco saying about 5% increase. This chart on the right is just the PMI for global food producers, and it's looking at their selling price inflation. And you can just see that chart in terms of it has now risen to its highest level on record. Next slide, please. So in terms of inflation, consumer price inflation, you can see on the chart on the left, so this is just year on year consumer prices. So this is the price of both consumer goods, such as food, and services, such as everything like a haircut or travel. And you can see it's up 5.4%. That's its highest level since 1992. And it's largely due to goods price inflation as opposed to services. Goods is rising at 6.9% currently, which is double that of consumer services. But if you look at the Bank of England's latest forecast on the right, and you can see the top line there is showing that inflation is going to peak at, they estimate 7.25%. So just think you have to get when you average that out, it sort of slows, it comes back, but it's still going to be high for the rest of the year. On average, it's going to be about 6% for 2022 as a whole. So unless you're getting 6% increase in your pay, you're not going to break even in terms of that. And that's before you think of tax issues and stuff like that. So you can see how it's going to be a couple of years of inflationary pressures. And the sort of red bars down there show the contribution that energy is making to the increase in consumer price inflation in the UK, where it's going to peak this spring at about 2 percentage points of that 7.25 peak, and then it's going to fall down to 0 as that sort of falls out. But whenever you get inflation of 0, remember that can still mean that prices remain high. It just means that they're not rising, the prices are not increasing. Where this is particularly important when you think of inflation, 7.25%, people on welfare benefits such as universal credit, their benefits are uprated from the 1st of April based on September 2021's inflation rate. So that was 3.1%. So you think of the squeeze that they're getting, inflation at 6% on average for 2022, and their benefits are going to rise at half of that. So that's clearly an issue for people on benefits. Next slide, please. Then we sort of move to the whole protocol and Brexit. And remember, Brexit is moving away from the single market and freedom of movement and absence of trade barriers to actually installing trade barriers, the border along the Irish Sea, all the customs checks, all of those sort of things. So that's going to be an added cost. There's going to be added bureaucracy. And so you think in terms of Northern Ireland and its exposure to all of these added costs is going to add to inflation and make things worse. And it's not just for this current time, this is going to be sort of going forward. But if we look at how firms have adapted to 1 year on from the protocol, there's a Chamber of Commerce and BDO quarterly economic survey where they were looking at it, and 1 in 10 local firms report that so far EU exit and the Northern Ireland Protocol has had a positive impact on them, and 57% of Northern Ireland firms are adapting to new arrangements, with a third of them adapting very well. But if you look at the negatives, you're having 36%, over a third of Northern Ireland firms are finding the new rules are still challenging, and 60% of Northern Ireland firms stated that the EU exit had a negative impact on their business. So it's still going to be problematic going forward. And if we go to the next slide, and if we go to, if we look at sort of what has happened and how firms have adapted and responded, there's actually new trade patterns have been emerging. And this is looking at what has happened with trade in goods between Northern Ireland, the Republic, and also the Republic of Ireland and GB over the last year. So that's January to November, the first 11 months of last year relative to the previous year. And you can see that exports from Northern Ireland to the south have increased by 64%, whereas goods going in the opposite direction have increased by 48%. Whereas you look at the big loser has been in terms of GB, in terms of export and imports. GB exports to the Republic have gone down by 21%, whereas the Republic has increased exports going in the opposite direction by pretty much the same amount. And clearly what's happening is trade is it's like water, that it follows the line of least resistance. And what we have been seeing, and again it's reported in the Chamber of Commerce survey, is that 23% of Northern Ireland firms who were exporters or planned or aspiring to export, they have actually brought their supply chains back to Northern Ireland to change them to Northern Ireland suppliers. And you've got 2/3 of Northern Ireland exporters have actually diversified their suppliers, with 60% of them swapping GB suppliers for suppliers in the EU, primarily the Republic of Ireland. So what you've been basically seeing is a switch between Northern Ireland going for Republic of Ireland suppliers and vice versa. And that's why you've seen the gain, particularly in sort of food producers in Northern Ireland have done particularly well, because Republic of Ireland has then sought to replace GB suppliers with people from Northern Ireland instead. So clearly there are gains in that, and looking forward, that is set to continue. Next slide, please. But what we're going to see then in 2022 is what I call running the gauntlet. And those people of a certain age who will remember the gladiators back in the 1990s will remember the gauntlet at the end, where you faced all the gladiators with pugil sticks and a whole range of things where they were battering you and hitting you, and you were trying to make progress. That's what 2022 is going to be like. We've got higher energy bills, wage costs. Then you've got this period of unwinding of existing tax cuts and stimulus during the pandemic phase. VAT for hospitality sector is set to rise back up to 20% in the next couple of months. Business rates relief sort of rolls off. But the big issues are going to be the national insurance contributions, the tax hikes, 1.25 percentage points for both employers and employees. You've got income tax thresholds are frozen for 4 years. And because inflation is so high at the minute, that makes those freezing thresholds more marked, in that you're going to see more and more people, if they get these pay rises, they're going to be falling over the threshold and paying higher tax at basically a lower level. And you can see essentially what Rishi Sunak's doing from that cartoon was, during the pandemic, whenever it started, so this was from, I think this was a cartoon from in 2020, where he was blasting people with cash, furlough money, etc., and it was all fantastic. Whereas now he's in the process of how do you get that back, and increasing taxation, etc. And it's worth bearing in mind that sort of like last year's budget was the biggest tax raising budget in a generation, and the UK economy is now set to have the highest percentage of taxation as a percentage of GDP coming up in the coming years for 70 years. Next slide, please. But the tax rises aren't all it isn't all one-way traffic. There's also the tax giveaway of the super deduction, which is for the next year, and this should stimulate significant increase in investment, and that's something that Northern Ireland needs in particular, because Northern Ireland businesses are serial underinvestors, and we know in the sort of banking sector that there's actually more deposits from SMEs than they have loans out for investment, and that has just been growing over the last number of years. So there is this tax incentive to spend now and invest. One of the challenges, particularly if it's in plant and machinery and even building factories, has been the supply chain disruption is actually making delivering on that investment quite difficult. Next slide, please. And if we just look at this sort of forecast for the UK economy, which was from the Bank of England, its latest forecast last week, you can see in terms of GDP, economic growth, we're looking at last year growth of 7.25%, and it's now expected to slow to just 3.75%. And what is worrying is when you look across 2023, 2024, slowing to 1% per year, that is pedestrian. And that's basically, if you were, that's within a hair's breadth of recession territory, and that is such slow growth. And think that's going to come up with coincide with a kind of general election. And one of the reasons for that is then what is happening, particularly with inflation. If you look at the other red bar further on down, real post-tax labour income, so that's after tax earnings, and you can see in this year alone, there's going to be a -2% decline, and that is the biggest hit in decades for households and people with their income, and that's all linked to inflation. The encouraging thing is in green, in terms of you're going to see some household consumption because of pandemic savings kind of rolling over from last year still to be spent, which props things up a bit. And that super deduction is expected to give a big boost, 13.25% increase in investment. But the key takeaway from this is economic growth prospects going forward are grim. It's a slow growing economy. And for Northern Ireland, I would say you're probably going from growth of about 6.5% last year to about 3 to 3.5% this year. And then that's going down to like 1.5%, 1%. So very slow rates of growth. Next slide, please. And so to just kind of really sum up in terms of what to expect in 2022, it's going to be a year of shortages, skills, goods, energy, and also housing. One of the big things has been the lack of supply in the housing market. And if you see in terms of the likes of Property Pal, the property website, that you've seen the number of houses for sale, the number of stock in terms of houses for sale is down 44% in the last in 2021 Q4 relative to the previous year, and that's happening in rental sector as well. Cost of living crisis, it will hit consumer sensitive sectors, and business will be this big rise in poverty. Then you've also got the cost of doing business crisis, you've got national living wage increases, energy, food increases, more tax, makes things all the more challenging. Yes, the Omicron wave is and the pandemic are subsiding and you're wanting to open up, but then you're being hit with all these headwinds, more tax and higher interest rates. We've also already seen the Bank of England move. I'd expect to see at least 2 more interest rate hikes this year. So you're looking at least 1% then the year for bank rate. We talk about the winter of discontent. Will it be in terms of a spring, summer, autumn and winter of discontent? Will we see industrial action whenever people are getting pay rises of maybe 3 to 4% if they're very lucky? Public sector may struggle to get more than 2%, and clearly that's going to be a squeeze in their earnings, or in their after inflation earnings. We've got a budget coming up on the 23rd of March, and the cost of living crisis is front and centre on that front. So what are we going to see in terms of budget? Are we going to see any tax cuts? Are we going to see any U-turns on national insurance contribution hikes, etc.? It's going to be a budget for households, that's for sure. Then we've got the whole adapting for Brexit, the post-Brexit and post-pandemic world, working from home. How is that going to change? And probably the biggest legacy, I think, of COVID-19, which feeds into skills shortages going forward, is what has happened to our education sector and our children at schools. There's going to be an epidemic of educational underachievement. Northern Ireland already fares badly on that front. That's going to get significantly worse. And you think of, we can't access EU nationals, we've got high levels of economic inactivity, and we're now going to have this conveyor belt of underachievement increasing. As a business, that poses problems. Will we see the investment boom from the super tax deduction, and the north-south trade boom is likely to continue sort of going forward, and there's going to be more supply chains being re-engineered and people taking advantage of aspects of the Northern Ireland Protocol, which are best of both worlds, but other aspects of it are effectively delivering Brexit, and that's going to continue to be problematic. Also, political instability is pretty much everywhere, whether it's Stormont with Brexit, Ukraine, or even China and Taiwan. But it's important to remember that there are always winners and opportunities in all sectors. And even when I sort of talked about the likes of the new car sales market being difficult, last year was a record year for Ferrari sales in Northern Ireland. They increased by 18 to 46. It was also the best year in 11 years for Toyota as well. So even when things are difficult, there are always firms and businesses and niches who can always take advantage of the opportunities and do well. And just finally, to close, and when we recover from all this pandemic, remember there's other challenges which lie ahead as well. So thanks very much for your attention, and I'll be happy to take questions.
Richard, thank you very much. I'm tempted to start off maybe by asking where the slide with the good news is, but I'm a little worried that I do recall the gladiators in the 1990s far too vividly, and starting to show my age, but we'll move on. Thank you for that. I think that was a fairly comprehensive and also candid overview and outlook for what you see as the year ahead. And it's fair to say there's a huge degree of uncertainty and a lot of challenge ahead. Maybe just pick up on a couple of those. Some good questions coming in. We've got about 15 minutes to get through some of those. But I was struck actually way back at the beginning of the presentation. It's almost like certainly in our lifetimes, and maybe for a century or more, this is something that we haven't really seen before. It feels for having come out of such a big shock with the economic consequences of that, it's kind of round the wrong way. And at a macro level, and obviously at a micro level, a lot of businesses have had a really, really incredibly tough couple of years. But at a macro level, the predictions of mass unemployment and a long sort of that long tail on recovery didn't really happen. And it seems that actually at that macro of the overall economy level, the pain, the worst pain is actually still come. And have we anything to compare that with in sort of living memory, or even beyond that?
No, you're right, Simon. We do live in sort of strange times, because normally whenever you experienced a recession, when the recession hit, you had job losses was the main source of pain, and unemployment was the main source of kind of poverty and squeeze on incomes and stuff. Whereas now that's not the case. We haven't had the surge in unemployment, but it's a squeeze on incomes, and it's almost like the working poor and the impact that that's going to have on them. So it is kind of strange times. And I suppose what surprised forecasters about things like unemployment and what would and wouldn't happen, and was the scale of the financial support, the fiscal support that was provided. And in many ways, that kind of anesthetized people, whether it was like through the furlough money, and now those painkillers are wearing off. And it's very difficult to how you're going to shield. We've heard Rishi Sunak in terms of England, where he's giving some subsidies for energy bills and things like that. But ultimately, we're not going to get in a position where either Rishi Sunak or Finance Minister in Northern Ireland is going to pay everybody's energy bills. You're not going to insulate from that. There is going to be the squeeze. I suppose it isn't going to last forever, whether it's a couple of years, but the problem is that that's going to hit. And it's almost like this delayed reaction from the pandemic, where people think we have got through it, whereas actually it's this kind of nasty sort of secondary wave of the impact, which is inflation, which is going to hit people.
And on that secondary wave, good question there from Richard Ennis. I'm not sure if it's maybe the Richard Ennis previously of your parish, but he's asked, but is it not logical then that if there is if what you're saying is right, and all of those pressures are there, and then consumer spending decreases in a way that it didn't during the pandemic, because you're right, we were talking about building up savings and there was various benefits that people were receiving. Is there not an inevitability then to a second recession, or certainly a significant dip in output if people have to contract and they're not seeing their wages rise commensurate with cost increases? Is there not a danger that we double dip at this time?
Yes, there is a danger of that. I think it's maybe too early to say, because that's part of the reason why we've had the huge rate of growth last year was like a rebound from the record contraction in 2020. Then we're still getting a kind of normalization kind of from COVID. So you're getting sort of kind of growth from that. But yes, you are going to see this is going to take out a lot of money from the economy in terms of inflation. And whenever you're talking about some of those growth predictions, particularly further out, like 1% in 2024, 1.25% in 2023, though, or 1.25%. So that's, you cough and you could knock that into a recession. That's how it's on that. But the thing is, people will feel like at the minute you're not in a recession, but actually when we were in a recession, things were better. So people get hung up on, are we in a recession is bad, being out of recession is good, whereas actually we're kind of out of recession now, and demand, particularly in manufacturing, is strong and there's growth there and stuff. But households will effectively be in recession. If you're on welfare benefits, you will be in recession, and that's sort of going to continue. It's also what's happening as well is, if you think what we did during the pandemic was we all switched. We couldn't go on holiday, we couldn't spend in restaurants, etc. So we all switched to goods, and we're all on Amazon and all of that sort of stuff. That with things opening up, you're going to see consumer spending pivot to back onto services, back onto holidays and things. So like I was listening yesterday on a call about, travel firms having huge demand and things like that. I suppose for our local hospitality sector, that maybe presents a challenge if we're not maybe going to be that tuned in for staycation, where we're all wanting to head for the airport and get out, for the holidays that we failed to have over the last few years. But it's that change in spending is good, because you want that to bring down inflation. Because one of the reasons why inflation is so high, there's too much demand for consumer goods. If you're able to spend money in consumer services instead of goods, that will help with the supply chain, that will help with inflation, and that will mean interest rates won't have to go up even higher. And
that you mentioned Amazon, and obviously as chief executive of Belfast Chamber, I'm contractually obliged to say that there are excellent retailers in our city who many of them also have online presences. But in terms of that overall inflation, just right across the board, it feels like at the moment, and particularly in labour and in energy costs and some of those other ones that you talked about. Ian Fraser asked a question there about Bank of England's levers. You mentioned that you thought we had at least 2 more increases in interest rates. Interesting to get your thoughts on where you think that might land at or ballpark with that, because it's been quite small and incremental so far. But also, what other levers do they have at their disposal to do something about it and arrest this? Because that 7% inflation, I think was a figure of that. That's, I'm sure we have seen that in our lifetime, but it's incredibly high.
Yeah. In terms of you have to go back to basically the early 1990s, until you've got that kind of 7%. In terms of, if we think there was last week, the Bank of England raised rates by a quarter of a percentage point up to 0.5%. There was actually 4 members of the MPC wanted to make a bigger move, a 0.5% increase. So I think we heard the chief economist from Bank of England yesterday talking about we can't get too aggressive with these rate hikes because inflation is expected to fall. There's a lag whenever you increase interest rates, normally about 2 years before it makes an impact. So they're trying to, it's almost a bit like they're throwing out a stinger to slow down the juggernaut of inflation, without trying to do it, without trying to topple the juggernaut of the economy over completely. So I think they'll go at least 2 more times this year, but they won't go aggressively. But that takes rates up to 1%. But the important thing is that even in the mortgage market, even with people, because there's been record lows in terms of some of the mortgage rates over the last number of months, and they're starting to rise. But even as people roll off their 5-year fixed rates, etc., they're still in a position today where they're going to get probably lower rates than they had previously. And if they're not lower, they're still by historical standards very, very low. So I don't think at 1% you're going to see that kind of necessarily derailing things. But markets at the minute think they could be increasing rates to 1.5% by early next year. And I think if you're going sort of beyond that, you're in danger of you are going to damage the economy and damage the recovery.
And you obviously you work for a bank. There's a question from Ellie Lagan there around lending. The general consensus is the pandemic has produced increased liquidity within the economy, and with those challenges and with those increasing costs, that will eat into some of that liquidity and the balance sheets that businesses have. So how do you see that working out? And do you, as a banker, what are you looking at in terms of the year ahead? And because again, that feels that that there is banks are well capitalized, have money to lend, but yet there's still those challenges out there. Again, that's a bit of a conundrum that we haven't not really used to. We're used to having it almost the other way around.
Yeah, it's totally different from the whole credit crunch, where there was the cost of credit and the availability of credit after the financial crisis were very problematic. That's not the case now. Banks such as yourselves and the other local banks are clearly in growth mode. And as I said, we have, since Brexit, basically since about 2016, you've seen the SMEs in Northern Ireland, the amount of deposits that they have deposited with local banks has increased more than the loans that they've taken out. And that has just diverged for the last 5 years. So there's huge amounts of cash on the banks, deposited at the banks, which is, maybe some of those people, some of the firms were reluctant to invest with Brexit and to see how things would work out. They've now got a huge incentive, tax incentive with the super deduction over the next 12 months to actually embark on that. So I would be confident that we will see an increase in investment. What we are seeing, though, in some sectors is a difficulty in actually delivering on that investment because of supply chain shortages. If it's haulage firms want to replace their fleet of trucks, they'll be told that it'll maybe be 18 months before they can get a replacement truck, all of those kind of things. So people are dying to invest, but they're being thwarted from it by the sort of supply chain shortages. But banks are very much in sort of growth mode, and there is the cash there from the business's own cash piles. And I would just hope, for the economy's sake, that we'll see a lot of that going into investment.
You mentioned Brexit a couple of times there, and just maybe thought you got away without being asked a question about it, but just a couple of minutes left. You took a fairly, I think, rightly a balanced approach in your comments earlier around protocol, and yes, there are problems, and there are problems for some businesses, but there are others who have seized the sort of advantages and are reorientating some supply lines. So there's political instability in Northern Ireland flowing from all of that, and we're perhaps well used to that, and businesses in Belfast and across the region, resilience and their just ability to adapt sometimes in spite of political instability. Obviously, that's something that is not welcome on top of all of these challenges. But any thoughts on how? I'm not going to ask you how you see the political instability issue at Stormont working out, but the need to get a deal around the protocol so that people understand what the future is. Any thoughts on that?
Yeah, well, businesses always have to deal with uncertainty, but particularly with the kind of protocol and all the kind of political fireworks that we'll be sort of seeing going off, there have been a lot of interest in terms of inward investors coming in to take advantage of aspects of the protocol which do present the kind of best of both worlds. We've heard that with one of the CAN operators, which is going to be setting up. We've heard that, like, the likes of Norbrook has talked about how beneficial and advantageous it is, and Almac is expanding by about 1,000 people in terms of linked to that. So clearly, for other firms, when you're trying to sell those benefits for firms to come in, it is pretty difficult, and it could dissuade some people when they actually see all the noise coming from kind of Radio Stormont, which is coming across, which actually makes them think, oh, how certain is this? And will this change? And all of that, where you almost need, ultimately Brexit was always going to create additional costs. It was going to create this disruption, this bureaucracy, all of that. That's a kind of given. And the protocol delivers on that. And yes, we mitigate it as far as we can. And my take is you try and make the best of both worlds, mitigate the problems. You're not going to mitigate them away. And it's also in terms of then take advantage of the opportunities and maximize that. But clearly the political instability and all of that, when it gets on the airwaves, if you're an investor, you may just switch off and look elsewhere.
Radio Stormont, there are endless opportunities for jokes related to that, although I do think I'm not probably the best person to make those. Leave that to someone else. Just finally then, we're hoping that we get some good news on those from Radio Stormont later in terms of removal of some restrictions, perhaps an amendment in the work from home guidance as well. And that is also bound to help in terms of activity, you would imagine as well. So that one of the things that we in Belfast Chamber have learned sort of very vividly over the last couple of years is that sort of sense of an ecosystem within the city's economy, and retail and hospitality are a huge part of that, not just in terms of their own job creation and the wealth they generate, but also that attractiveness as the city to tech firms and the professional services firms. So that return to normal, if that's, for want of a better phrase, whatever the new normal is going to be, which will surely help a little bit as well in terms of not just that activity that it generates, but also Belfast's attractiveness to investment notwithstanding we were previously talking about.
Yeah, absolutely. And it's even the opportunities that the post-pandemic world with working from home now opens up. The fact that one of the reasons why the property market is so buoyant has been people coming back from GB and taking up jobs. And yes, there are negative effects of that in terms of people who are trying to get in the property ladder and maybe can't. But the positives are ultimately we want Northern Ireland and Belfast to be an attractive place to live, work and visit for more and more people. And working from home enables people who can actually live here, even if they want to work around the world. And, you know, that's clearly positive and one that we need to take advantage of.
Richard, thank you very much. There were a lot of questions that we weren't able to touch on. There was constant themes throughout them around Brexit and just rising costs, particularly around energy. So, you know, thank you for giving us that outlook for the year ahead. Feels like it's a bit of a rocky road ahead, and a lot of uncertainty. But thank you for going through that so methodically for us and for answering those questions. Thank you for that. Can I just also thank Ulster Bank again for its continued sponsorship of Belfast Talks Business. Can I thank Neil and the team at Plan for helping this morning to go so smoothly. And please go to our Belfast Chamber website, belfastchamber.com. You can see the events that we have upcoming, including our Belfast Forward conference at the end of March. So thank you everybody for your attendance this morning. Hope you enjoyed that. Look forward to seeing you all again very soon. Thank you.